Hello, everyone, and welcome back to Outspoken Market Global. Leandro Guerra is speaking. Many people still believe that in order to be a quantitative trader, you must have a deep knowledge around the statistics, machine learning, AI, mathematics in general. Of course, it depends on where you're going to work and what you're going to do. And as well, you must know some programming languages such as Python, C Sharp, C++, among many other possibilities that we have. Now, of course, that it's absolutely true. I, for example, consider myself a good Python programmer, a quant. I do have a bachelor in engineering, a master degrees in finance, and things like that. And I work managing data science and a platform team. However, my point in this class is you can keep things simple and already do some quantitative trading using a spreadsheet software, whether if it's Google Sheets, Excel, it doesn't matter. And what you must know are the principles, and the first principle is keep things simple. Yes, complex stuff, they will have their place, but we are speaking here for retail traders, regular people that they have a work, they have a job, they have other things to do. Eventually, they will have some time on it. They can dedicate themselves to trading and even taking this to a full time job. And you must start somewhere. And the goal of this class is to teach you how you can have a profitable strategy using GBP USD. So we are speaking about the Forex markets. This example is with the 4-hour time frame. You can place any other variations, time frames that you want to test and advise you to test. But please stay with me and follow the principles. To start doing some quant trading, what we need is some data. And according to the down theory, everything that is known from the markets, and also according to the efficient market theory, everything will be already in the price. That is not entirely true, although it works like that most of the time. But the reason I'm saying it's not entirely true is because it's known that the market, yes, has some inefficiencies. Otherwise, nobody would make more money than the average. First point. The second point is people, they do trading for thousands of different reasons and interests. So in between all of these market participants, there will be an edge that you can take advantage of. And that edge, as I like to teach my students, it's about the inertia of the market, and it's about you being able to capture one of the two possible movements any asset can do, or a trend or mean reversion. And most of the time, the market is mean reverting. That being said, if we start analyzing this GBP USD dataset is starting from the 22nd of October 2023. We are using, as I said, the 4-hour time frame, and I have, based on the principles that I described so far, only 4 data points: open, high, low, close. And actually, in this example, I'll be using only one attribute, the closing, to start with. And from the close, we are going to make a couple of other attributes. The moving average of 25 periods, it's here. Don't need to explain myself what a moving average is. At this point in time, if you're already into trading, you already know what it is. If you have any doubts, just let me know. And then the RSL, the relative strength Levi. This indicator is nothing else than the distance of the price from its moving average. So with these two things, based into the closing, we are going to establish a long rule to run our quantitative trading. That will be without any emotion, without any subjectivity, without any human interpretation of, oh, look at this chart. No, no, no. All of this is waste of time. Technical analysis, chart analysis, they are waste of time. That being said, once you build using in Excel the average from the past 25 periods that we are going to have, and the RSL will be just the close divided by the moving average value subtracted by 1, so we can have the percentage. And then we have this column that is the return in pips, because we, when trading Forex, we are pretty much use it to measure our returns and measure many of our things in pips. So I'm already doing this calculation for you, and this is the return. It's not a percentage because I will not be compounding the results, because people, they will have different trading system managements, risk management, so I'll keep it simple. And then I have the column J that is or is representing the future returns. So for a certain given data point, the respective value will be the next point. And this is for me just to be able to calculate if the rule that we are using to go long will make sense. And why I'm using the future returns? Because I want to check if, based on the way that I'm going to close this candle, I will be able eventually to make profit. Of course, in the following one, I cannot make profit from the current one and from the past ones. Makes no sense, of course, right? So in order to run my backtest, I should do that way. What is the long rule? Remember, I told you in the beginning of the class, the markets, or actually any given asset, will have two main movements, a mean reversion or a trend. Here we are exploring the mean reversion move. So whenever we go below a certain threshold or a certain cutoff point from the RSL, right, I will trigger my long rule. And therefore, my result is going to be naturally the future returns. If I don't trigger the rule, I will return 0. And you see here that I have also this O2 cell that are the costs, that at the moment they are 0, but I will get there to the point explaining, and you should always include the cost. So I'm here assuming that you will trade the 4-hour candle. Based on the information you have now, you will trade the next. Also, notice that I'm not including any risk management. I'm not including any stop loss. So everything that I'm going to show you will likely become even better once you apply these particular rules. What is the long rule? So if my A2 column, the RSL, is below or is lower than minus, we have here a minus sign, the cutoff of 0.2%. So when it's below the average, the close it's below the average by minus 0.2%, I will have the future return minus the cost. Otherwise, I will not trade, so I will have 0 as return. Take a look on what happens when I run it. We would be having, and we don't trade all the time, right? So actually, we have 4,000 data points. if I just select the non-zeros, so let me exclude the zero, we will see that we only be trading, let's see what we have, 27%, but no, actually 30% of the time. Only 30% of the time we will be trading. So 30% trades, meaning that we stay out most of the time, which is natural, is expected. You don't need to trade every time. If you lose something now, there is market in the next candle, there is the market tomorrow. And also, remember that I said that I'm not applying any risk management nor any kind of stop loss, and I'm not also counting to discard the night candle that eventually nothing happens. Or so in the Asia session, if you are in the West, you will not be trading that. If you are watching these from Asia, or from because here I am on the Central European time zone. So you may choose even to filter which trading hours or trading sessions you would like to follow. So take a look on how amazing it is. Now, if you have ever seen any kind of quantitative approach before, or if you know a little bit about mathematical modeling, you will say, well, wait a second, Leandro. You are doing something wrong, because you are assuming that the market has this mean reversion behavior, which is true. It's here in the screen. That's fine. It was your hypothesis, and I mean, it seems to be true. We cannot reject it. However, you are already placing a cutoff point that makes me profitable. And you are applying this to the whole database. So you are cheating, because it's quite easy to apply something to the whole database and then say that, yes, you see, it works under these conditions. And then when we have unseen data, we have no idea about what is going to happen. Yes, but that is the point, my friends. I'm not applying this to the entire data points. Remember, we have 4,000. I'm applying this to half of the database, only 2,000 points. Now, if I have outside this training or fitting sample, if I expand this right to the rest of the database, how this would behave? Well, let's see. Amazing, isn't it? So half of our database was around here. And then we are still profitable in the rest of the database. It's pretty cool, isn't it? It's really, 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 really cool. So my rule, my trading rule, my quantitative approach works even when applying this to unseen data. And that is the way you should do it. Whatever test you do, so you want to establish, I don't know, a new cutoff point. You see, here we are improving it. We get even a little bit more. So we touch 1,400 pips. If I go even further, then you see it makes a whole difference. No, it's not working so well. So you can play around with the numbers, so you can try to get something that is profitable. But the point is, you then only consider this viable if you move forward to your unseen data and check if that is yet profitable. This is the first rule. The second rule is, of course, applying the costs. This is what we are going to make. But are you following me? Of course. If you know programming, if you know Python, for example, this that we are doing here by hand is going to be way easier. Actually, we can have the machine to optimize these parameters for you, and then you don't need to do this manual stuff. But remember, my goal with this class is to teach you a couple of things. One, the principles of modeling, the principles of quantitative trading. And the second one, that simplicity works. And that you can start even if you have zero knowledge. And then naturally you will evolve with time, and the need of doing other things will push you forward towards programming. But you don't need to wait to get there to start doing something that it's relevant. This is the key message. There is something else that you can do. So now let's get back to our half of the data set. And then eventually you could play around with other trigger points and see what other interesting elements you can have, right? But the sweet spot here around here. You can also, of course, change the size of the moving average, the how many periods. Here we have 25. You may want to do something different, okay? So it's up to you. Another important thing, right, are the costs. And we know that day trading Forex, essentially what you're gonna have is the spread, bid and ask spread, especially in a 4-hour time frame. So it's unlikely that you will have the overnight costs because you will not be trading on the change of the day. So that won't be applied to you, or you pay attention to that to avoid that additional cost. So if you add, right, the traditional spread that we have, please have in mind that here, I know we are speaking about things that are simplified, but it's still, how many traders you know that consistently can do this amount of money in Forex for so long? I know it's not that much in pips, but remember, you are trading just 30% of the time. Now, you want to do something interesting, is that, look, my premise, it was just that I will capture the future return of only one candle. What if I get from 2 candles? I just come here and sum the next. Huh. You see what I mean? And then you add rational leverage. You do many other things. You will see also that you cannot sum up forever. But there will be, for example, if you consider 3 candles, so something happens in the existing candle, you will stay positioned no matter what for the next 3, and then you exit. You see, you scale your results. You can do that. Oh, but Leandro, what happens if we have like that 2 concurrent signals? So we have one signal in this candle, and I will be positioned therefore for the next 2. And then in the following one, I will have another long rule activated, so I need to enter again and be positioned for the next 2. Yes, yes. And then here you will be slightly leveraged, but it's fine, absolutely fine. Already discounting the costs. And then again, eventually you can check how this is going to look like in the entire database. So you will be in a drawdown at the moment, but yet extremely profitable. If you have, and I know there are some brokers that they allow you less cost, you can have something. And now, what is your task as a quant developer? But how can you say, Leandro, that I am a quant developer in Excel? Really, if you go down that route, if you don't believe that you need to start from something that yet can be simple but functional, then yes, maybe trading is not for you, but you can. That is my point. You can start from here. And literally doing this kind of stuff, you will be more profitable than any chartist. Because this, remember, this is the entry point, and you already can do something. And I'm not here stressing all the possibilities of things that you can Try out. You can do it. Many other things, right? Add other type of rules. Find also the short rules. So now I'm trading with the three future returns. And then you can change the moving average length, right? So if I come here and then I pick up something that I will go even further. I mean, just making my point, and then I'm going to see. Eventually, you will get better. You see, you got a lot better. And what I did is to increase the length of the moving average, right? From this test that we did. So here we have 35 periods rather than 25. And even if you have cut off in half, you will see that the result would still be very, very good. So here we have a moving average of 35 with operational cost that will vary. Of course, you adapt to your broker, and then if that curve does not fit to the broker that you have, you will naturally will have to develop. But my objective was to give you something that you can start working from now. And this is one of the pairs. You can pick up another pair and then try to see, and then you can apply volatility rules. You can apply sizing. You can apply risk management. And this will only get better. Am I clear, my friends? Of course, study. This is not a recommendation, but this is to show you the potential that you can start, and you don't need to start from scratch. You can download this spreadsheet that will be available at the om-qs.com, and from here you can start your quant trading journey. And count on me to take any questions that you have to help you with your doubts. And if you have any subject for a next class, I'll be more than happy to hear from you, and then we can meet again. Take care, trade safe, study a lot, and see you next time. Bye bye.